Yeah, so high level, Nick, what do you hope to get out of this call today?
Hoping to just get a little more information about bringing an investor into a deal and making sure it's a fair return for them and for us.
Okay, so
So,
give me the context here.
so there's a existing building with an additional 5 acres. It's got um, a 3 unit building that's existing and then 5 acres behind, and we can build a total of 41 units. So we're planning to buy the building, build the 41 units in the back, and then either sell the building off in the front if we can owning, or just keep it all residential multifamily. So
Okay. And then
uh,
what's the current use of the building in the front?
it's one, the family lives there, and then they have one tenant and then one vacant unit. But they're hoping to stay if possible. So we're planning to give them the option to stay for a few years at a very discounted rent, just so they can hopefully pick our offer.
Okay, so it's three residential units currently then?
3 residential units currently. Yep.
Okay, and then what is the so you said it's approved for a certain amount of units. Tell me about that. Is it already fully entitled and approved or what?
Not entitled and approved, but it has the correct zoning for 40
Hmm.
units. So it should be fairly easy to go in and get approvals for that. I mean, nothing's easy, but easier than trying to rezone something or create a PUD.
Hmm.
So hoping to buy it, do the value add of getting it approved, and come up with some architecture plans and then build it. So that's kind of the initial plan. But we've got some other projects we're working on, and we don't really want to refinance any of them to pull cash out to do this deal. So we
Okay.
were thinking about bringing on an investor
Hmm.
who would. Our first thought was he could provide all the cash for the purchase and all the cash for all the initial um, engineering and miscellaneous fees, and he could provide the down payment, and we would just provide the equity in form of building the project and finding the project.
Hmm.
So that was our first thought, but we weren't sure if there's a better way to do it. Whether it should we not be giving people equity if we can avoid it,
Hmm.
or like what do you typically do on a project?
I mean, it kind of depends upon the project, right? So one thing is that what would be the total debt stack on this project if you were to bring it to a bank and construction financing and like rolling it all into that?
Yeah, so it'd be, I think the project would be about $8 to $10 million total. Um, and then we would just finance the construction through cash flow from other projects. So we wouldn't really take on debt for um, the actual construction. We would just refinance and pull that additional cash out.
Okay.
That's how we typically have been doing it, but that's not to say that's the best way to do it.
Okay, because the thing I'm trying to get a sense of it in terms of like from an equity structure is if the total amount of debt you're going to put on a project is in alignment with what your net worth is or what the net worth of the ownership group is,
Yep.
then you can maintain your strength as a personal guarantor so as to not have to bring in a partner that is going to have to personally guarantee that whatever debt you're going to put on the project.
Yeah, we don't need the personal guarantee for this one. We don't even really need the partner. It's just we don't want to refinance one of our other projects to get the extra cash to do this project. So the investor had reached out to us a few months ago, just saying, "Hey, if you come across any interesting projects, I'd be interested."
Hmm.
So more just giving him the opportunity if it makes sense for us and for him.
Okay. So what would that private loan request look like if it was a loan in terms of the total cash you would need for the purchase and all the
Uh,
other stuff you're talking about?
uh, Probably just under 4 million, like 3.5 to 4.
Okay.
So I think we try to do like just over uh anywhere from 50 to 65% loan to value on the loan.
Okay.
And he would just provide that other portion of the equity, either a loan or through true equity
Okay.
in the deal.
And how would they get paid back their principal?
That's always the problem we run into. Uh Trying to figure out what like a fair return is, whether like if we did just do debt, obviously it'd be interest only payments until we refinance, and then we would pay them back at the refinance.
Hmm.
If it was equity, that's the one we're not too sure about. Obviously, they would get a portion of the returns from cash flow, but we're not sure if it makes sense to give them a preferred return until their cash is paid back, or what other people do, because we never really have ever given preferred returns or on any of our other projects.
Mm-hmm. Yeah, it's like 3.5 to $4 million capital request is typically, I mean, the way that I structure a lot of my deals where I'm keeping all the equity is that it's typically like a max like $1 million raise where I'll cobble together the cash from like let's say 2 to 4 different investors that just want a guaranteed rate of return.
Yep.
Like
So
a,
you just give them like an 8% return or something like that on their money.
yeah, whether it's an 8%, 10%. I mean, it really depends upon the interest rate environment because back in 2017, for instance, we were raising capital and promising a 7% fixed rate of return, guaranteed by the project and personally guaranteed by us. And we were oversubscribed at every raise we did. But now we're battling against the tail wagging the dog here with the free and clear rate of return, let's say being 5 to 5.5%. Mind you, this is the reason why it's important to engage in the discovery process with potential investment partners early on to really find out what's important to them. And during the easiest time to raise capital is when you don't need it, right? You've probably heard me say this before,
Yeah.
because you're talking about really boiling down into an essence in terms of what their goals are. So, and through the dialectic process, I'll ask them, hey, right now an FDIC insured money market account is paying, 5%, 5%. Why aren't you putting your money into that? Right. Well, yeah, I've considered doing that and, blah, 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 blah. And then I asked him, I was like, it's great that return is, that high now, but when the Federal Reserve starts cutting rates, then that rate's going to drop and you're going to basically be leaving that money in there. And that rate drops very quickly when the Fed starts cutting its Fed funds target rate. Right. So before you know it, you're going to be going from 5% down to 2.5%. And a year or two is going to pass you by before you even realize it, right? And then you're looking for the next opportunity. So the opportunities that we present a longer term, predictable type of cash flow situation for those investors. Generally that's what I do is I just raise in terms of promissory notes for something like that. But 3.5 to $4 million, that's a lot of different investors. Maybe you have somebody that is that's willing to lend that amount. Something that you can do in terms of your global cash flow, if you're looking to actually fund interest payments and different phases of the project from your global cash flow in your portfolio, is trying to reverse engineer what a fixed rate of return type of like promissory note would look like that would work for your global cash flow. Right.
Okay.
Global cash flow, I'm talking about, I don't know, the cash flow of all your properties and all that stuff. Right. So for instance, if you couldn't support, like, let's say a 12% annual rate of return with taking your global cash flow into consideration, what you could do is you could say, we'll pay you out, if they're looking for cash flow from day one, right? This is typically in the age ranges of 50 years old plus, right? They want some sort of cash flow on their money. So we'll propose, okay, well, the project and all of our other projects from a global cash flow standpoint will only support, let's say, 6 to 7% distributed monthly, but I know that you want 12%, so we'll have a catch up and accrual on the back end for when we refinance this property, is that when you'll get paid back your entire principal plus the accrued interest on the project, right? So you could be accruing, let's say, 6% on the back end, 6% on the back end, assuming let's say it was a 12% type of return, right? Because this is what the project and our company supports, right?
Okay.
So kind of figuring out that number comfortably, leaving a certain amount of buffer from a global cash flow standpoint. That is the most cut and dry way to put together a deal like this and also keep as much of the equity as possible in a project, and the way I've done it in the past.
Okay. Yeah, I think that would probably our preferred option. We don't obviously want to give away equity if we don't have to.
Hmm.
And this investor, his like second words he said was, "I'm not all that interested in making a good return. I'm just bored." So hopefully that means he's okay with no equity, but we'll find out more on Thursday when we talk to him. If he does want equity, what do you typically do for that? Do you just give a small portion, or um, what's like your preferred?
So let's in terms of protecting the names of the innocent and stuff like that, let's just talk, let's just refer to them as the money guy, right?
Yep.
So how do you know this person?
Uh, Family friend slash he was a business partner, well, business owner that we worked with quite frequently for 40 years.
Okay, so there's a long-standing relationship there then.
Yeah.
Okay, that's awesome. Awesome. Okay. Yeah, because that's the one thing I'm, in terms of the commitment, that it's not somebody that you met like a couple months ago, for instance.
No, no.
Okay, perfect. Um, if it was an if it was an equity scenario, if you're going to refinance, then you're
Mhm.
going to put debt on the property, and typically a bank is going to want to look at who has certain membership interests in the LLC that
Yep.
owns the deal, right? So if this person is not comfortable with, let's say, signing on the debt, whatever type of permanent debt you get on the project after you finish it and get it stabilized, you're going to want to cap their membership interest at 19%. 19%
Yep.
is the magic number. Once they go above 19%, typically most banks will require that person to have a personal guarantee. They're going to require, personal tax returns, personal financial statement, their credit to be run, and all that stuff, right? So if you're going to give up
Mhm.
some equity, and perhaps this individual might want to be part of the ownership group so as to get some type of tax benefits associated with it, right? So you can, through by way of the operating agreement, you can customize distribution of tax benefits in the ownership group. You want to work with an attorney that is versed in putting together operating agreements on real estate deals.
Yep.
Um, but it depends upon their objectives, right? Um,
Yep.
so that's what I would do. If they're like, no, I want more equity, then you just have to have them prepared that, okay, well, we're going to use your cash to get this, we're going to use your cash and also our cash to get this thing to the finish line in terms of
Yep.
construction, lease up, and stabilization to get it bankable from a permanent financing standpoint. So are you comfortable? Do you want to be a personal guarantor alongside us, or would you rather, be limited at the, having limited liability, for instance?
Yeah. Okay. Yeah, I think that all makes perfect sense. And it sounds like we need to get more information from him to determine what he wants, um, before we can really structure a true agreement. Obviously, um, we're going to meet with him on Thursday, so I'll know much more after that.
I mean, how time sensitive is the need for the cash for this deal?
Not super well. We're putting an offer in over the weekend,
Okay.
uh, but we won't need the cash right away. We could fund the purchase ourselves, and he could just add the funds later if
Okay.
that's the way we want to go. Um, so it's not super dire,
Okay. So you
but
have the
I'd like
bill.
to. Uh,
So you have the ability
just
to
want to.
take take this deal down with your own cash resources then.
Yeah, we could do the deal all on our own, but like I said earlier, we just don't want to refinance another project to do all the construction. We just want to be able to do it simultaneously with our other projects going on.
And always use this as like as a bridge to get you on the other
Yeah,
side. Okay.
yeah. Use it as a bridge to get to the other side, and also do our first deal with an investor to see how it works. So it doesn't have to be perfect, and we're okay giving up more equity or giving up more, like larger interest payments. But we're just trying to play the field and see how it works before we go to even larger projects and find more investors.
Yeah, I think that that's really smart. I always say it's like there's two sides of the token of it's best to ask for the money when you don't need it, because one thing is that when you partner with somebody, whether it's from a private lending standpoint or an equity standpoint, and you even have your own cash resources to do it on your own, the best way to establish a track record and relationship is when they get those, like, little love letters each month you send them, if it's going to be distributed monthly, in
Yep.
terms of, I mean, that's the proof of concept, right? And that circular reference point that you can have with that successful relationship you had with this investor and other people that are in their sphere of influence, and having like that consensus building part of what we teach in the 1-1-2-3 method that's in my program. Um, yeah, and I think that the the one thing that you have that's a competitive advantage is you have an actual construction company. So I think it would be smart to keep this cut and dry, and it being a debt instrument, because you can create the equity based upon the cost basis that you're going to have in your construction projects, because you're not going to have the overhead and profit that has to get added on to when somebody's hiring a third party general contractor, for instance.
Yeah.
So that's essentially your equity. Um,
Okay.
and besides, on a project like this, like when you're talking about equity partners, then now you have to do an annual K1 for a partnership return. It's just additional stuff that you have to do when it's not even in alignment with what the actual true motivations of the investor are, which might just be a better rate of return than they can get in the stock market or in the bank, for instance.
Hmm. Okay. Yeah, I think that's our preferred option too, but we'll find out more Thursday. If he does want equity and like our goal is to not put up any cash at all for this project, what is a fair split of equity, do you think? If he puts up all $3.5 to $4 million of equity needed for the project and we don't take any builder profit, or maybe we do take a builder profit, um, what is a fair equity split just in your mind? Or does it really come back to the return he gets on his money? Like if we think we're going to have 20% cash on cash return, does he need to get the 20%, or does he only need to get 10, or um, does it really just come back to that return number?
I mean, this is why I'm thinking it's smart in terms of your meeting this Thursday is to treat this as a discovery
Yep.
into what their wants and needs are, and what they don't want, most importantly. Then you can customize a scenario for them. The worst scenario to be in, and I know this is kind of counterintuitive. The worst scenario to be in is to be in the scenario of like presenting, this is what we're proposing, and then having to be countering objections for that. Because
Yeah.
when you're countering objections, then you're already on your heels.
Hmm.
So the best thing is to get into deep discovery with them. Hey, we have this opportunity. We want to figure out how to work together. We want to figure out how to work together on this. These are what our objectives are. We have a ton of equity in the buildings we already own.
Yep.
We have the ability to do this project on our own, but we'd like to be able to do it in a more efficient way and also create a win-win scenario in the process. So, what's more important to you? Higher rate of, just a higher guaranteed rate of return, or no guaranteed rate of return, and having equity upside in the project.
Okay. Yeah.
Uh,
Yeah. I, that was one thing. We weren't 100% sure what options were out there. Um, so we wanted to make sure we were familiar with a good portion of them before the meeting on Thursday.
mhm.
So I think this definitely helped clear up a lot of the options out there. And I did get the Bigger Pockets book, the how to work with partners and investors. So I read through that one over the weekend, and that cleared up a good portion of the questions. So
Yeah,
awesome.
so the different ways you could split this thing is that a standard syndication split, for instance, and this wouldn't be a syndication deal, it'd be like a joint venture or just like a private
Yeah.
partnership, would be like 70-30, right? 70% to the investor who's putting up the cash, 30% to the general partners, which would be you guys, for instance, right?
Do you do syndications? Is that how you structure your deals? No.
No, they make my freaking head hurt, man. I just, I'm in the sub $10 million space.
Yep.
You can develop your own real estate empire, during your first $10 million to $15 million of deals like we have, without ever
Yep.
having to do a syndication. Once you start getting up to like the, 20-50 million dollar deals, then that's when you're looking to pool more investors' money together.
Yep.
We never worked with more than, I guess, we never worked with more than four investors on any given deal.
Okay.
So once you start getting into like 25 different types of investors, then that's when you start getting into the SEC regulated territory.
Yep.
And I mean, you can build the real estate empire of
Mhm.
your dreams before ever having to call an SEC attorney.
Yeah.
If you're, if you're intentionally out there networking and, working relationships with the right people, which this guy seems like it's a great opportunity to create a win-win
Yep.
situation with the two of you.
Mhm.
And you can take this thing and roll it up to a, $50 million worth of real estate holdings from this one relationship, right? If you play your cards right.
Yep.
Um, and that all comes down to what makes them tick, right? What's important to
Mhm.
them. And so generally on sub $5 million deals, 50-50 split could be a thing. I think 70-30 is definitely something that might be higher to the benefit of the investor, probably more generous than what they actually need. Um, or, you could do something that, hey, we're gonna give you 19% ownership interest in here. We're gonna work with your CPA and your attorney to come up with an operating agreement that's customized to the max benefit of both parties.
Yep.
And so if they're looking for depreciation benefits, then you can customize an operating agreement that's in alignment with those. Because you and your ownership group may not care about depreciation benefits because you get so much freaking depreciation from the assets you already have. You don't need it, right? So, what can we do to customize this to benefit that need for depreciation benefits and tax efficiency on a given investment?
Okay.
Um, so you could do something where it's like all right, we're gonna give you 19% because you don't want to sign on the personal debt. But
Mhm.
we'll give you, we'll pay you out and let's say they're not really motivated by cash flow now. They're motivated by, long-term wealth creation, long-term equity multiple. Give them 19% ownership interest, but 10% preferred rate of return on their money that starts
Mhm.
getting that starts getting paid after or distributed after full stabilization on the property, for instance, right?
Okay. Mhm.
So let's say this project is worth $8 million when it's all leased up and stabilized.
Mhm.
It's worth $8 million when it's all leased up and stabilized. So you're able to get 100% of their investment capital back to them, their principal, and then maybe some additional cash out proceeds to pay any accrued preferred rate of return to that individual. And then whatever of their money is left still in the deal, they can still accumulate that preferred rate of return, right? Um,
Okay.
Another scenario you can do is we'll give you 70-30 while your money's in the deal. Once you get
Mhm.
100% of your investment capital back, then it flips to 70-30 the other way.
Mhm. Wow. There's so many options out there. It makes it difficult to really determine what you're looking for without knowing exactly what they are looking for. So,
Yeah, just don't go in there with a preconceived notion as to like this is what it is. I just think that it takes time with the discovery process. One thing is that you can get this deal locked up this weekend.
yep.
You can get this deal locked up this weekend. Put a due diligence in the contract there, which gives you an out to
Yep.
go through at least getting a pulse check with zoning and building department, and also hammering out what it might look like with this relationship with this investor, for instance, right? In terms of how the schedule of values is gonna play out on
Mhm.
that, right?
So,
Um, and it gives you some runway to figure all that stuff out. And then if you can't figure it out, you can, worst case scenario, you can pull the plug on the project and get your earnest money deposit back.
yeah, true. True.
But what I would do is I would invest all of the stuff that doesn't cost you money in
Mhm.
terms of due diligence, um, to figure out, make heads or tails of this project in terms of how you're going to structure it, in terms of the total ownership group, whether it's going to be a debt deal, whether it's going to be an equity deal, whatever. And then you can start paying for third parties and that sort of thing. Once you have that all figured out, third
Mhm.
parties associated with, because there's a lot of stuff you can do during due diligence in terms of getting the ball rolling on, the engineering and the site plan and the MEP on the all that other stuff, right?
Mhm.
Um,
Yeah. Yeah, I think this is definitely a project we want to pursue and hopefully use an investor for. So, um, I'm sure we'll have to talk again about this after I meet with them on Thursday, or maybe we'll just talk at the RIA meeting.
Yeah, no, absolutely, man. I hope you got some value out of this. I'm gonna stop recording so we can maybe talk about the maybe talk about the names of the innocent and all that stuff. So I hope you got some value out of this. All right.
Yeah, I got a lot of value. I really appreciate it, Matt.
Thanks.